Okay, so get this. This week,
Yeah.
the market's facing like a perfect storm of
Right.
events. It's not just the Fed meeting, which,
Right.
granted, is always a big deal. We've also got
Yeah.
elections, the jobs report dropping, Apple's earnings call, and,
Right.
oh yeah, global stuff.
Oh, yeah.
Like the Bank of England's
Those-
rate decision is happening too. So you're probably thinking, how do I make sense of all this?
Right.
That's why we're here. We're diving deep, cutting through the noise to help you figure out what really matters for
Yeah.
your investments.
Yeah, you got a point. It's a confluence of events that could send the market in any number of directions.
Right.
It's not just about understanding each event in isolation. It's about seeing how they interact and potentially amplify each other.
Right, like a chain reaction.
Exactly.
So let's start with the Fed.
Okay.
Everyone's expecting them to hold rates steady this time.
Right.
But the real game is figuring out what they're thinking
Yeah.
about the future.
It's true. Remember back in 2013
Oh, yeah.
when Ben Bernanke
Yeah.
just hinted at slowing down bond purchases?
Oh, man.
The market went haywire.
Yeah.
That's why everyone will be hanging on the Fed's every word this time,
Right.
looking for any clues about inflation, the labor market, and whether they're whispering the R word,
Oh.
recession.
So it's less about the actual decision and more about reading between the lines.
Yeah,
That sounds tricky.
it is.
What specific phrases should we be listening for?
Think about it this way.
Yeah.
The Fed wants to walk a tightrope.
Okay.
They want to fight inflation without spooking the markets or causing a recession.
Right.
So if they say inflation remains elevated,
Yeah.
that could signal more rate hikes are coming,
Okay.
even if not right now.
Yeah.
On the other hand, if they talk about cooling wage growth or monitoring economic data closely,
Right.
that could suggest they're getting ready to pause.
Okay, so it's all about nuance and trying to gauge their overall mood.
Exactly.
Got it. Now, how about elections? It seems like this time around, the focus is less on broad market moves
Yeah,
and more on how specific sectors might be impacted.
that's a great observation.
Yeah.
This election has really put a spotlight on sector-specific risks.
Oh.
Take healthcare, for example.
Okay.
Depending on who wins,
Right.
we could see major changes to drug pricing, insurance regulations,
Right.
or even the structure of healthcare delivery.
Wow.
That's going to have a ripple effect on companies across the entire healthcare sector, from pharmaceutical giants to small biotech firms.
So instead of just asking, will the market go up or down,
Right.
investors need to be thinking, which industries are going to be winners or losers
Exactly.
based on who's in charge? That's a whole different ballgame.
It is.
And I bet energy is another sector
Oh, yeah.
with a lot riding on this election.
Absolutely. The debate over fossil fuels versus renewables is front and center.
Yeah.
And the election could have a huge impact on energy policy. Right. Will we see more investment in clean energy? Will there be new regulations on drilling or pipelines?
Right.
These are all questions that energy companies and investors are grappling with.
And of course, we can't forget about tech.
Well, for sure.
It feels like everyone's got an opinion on how tech should be regulated,
Right.
from antitrust concerns to data privacy.
Uh-huh.
How might the election impact all of that?
Tech is definitely in the crosshairs, and the election could determine the direction of future regulation.
Okay.
Will we see tougher antitrust enforcement breaking up big tech companies?
Wow.
Will there be new rules around data privacy and online content moderation? These are all questions that will impact the future of the tech industry.
Yeah.
And investors need to be paying attention.
It's like every industry is holding its breath, waiting to see how the chips fall. Well, let's not forget about the elephant in the room. Taxes.
Oh, right.
Depending on the election outcome,
Yeah.
we could see changes to capital gains taxes or corporate tax rates.
Uh-huh.
And that's going to affect everyone.
Taxes are always a wild card. Higher capital gains taxes could discourage investment,
Yeah.
potentially leading to a market slowdown.
Right.
On the other hand,
Mhm.
lower corporate taxes could boost profits and lead to higher stock prices.
Yeah.
It's a complex equation with a lot of moving parts.
So we've got the Fed trying to walk a tightrope, elections shaking up entire sectors,
Right.
and the looming specter of tax changes.
Yeah.
And that's just the first part of our deep dive.
We're just getting started.
But before we move on, let's take a minute to unpack that jobs report coming out on Friday.
Okay.
Everyone's focused on that 180,000 new jobs estimate.
Right.
But is that the number that really matters?
That's a good question.
That's what I'm wondering. It feels like there's always more to the story than just hitting that magic number.
Yeah.
What else should we be paying attention to?
You're right. There's always more beneath the surface. Think of it like this. The jobs number is a snapshot, but wage growth is the movie.
Ooh, I like that.
It tells us if inflation is really cooling off or if businesses are having to pay more to attract workers, which could fuel even more inflation.
So a strong jobs number is great, but if wages are also skyrocketing, that could actually be bad news.
Yeah.
That's kind of counterintuitive.
It is, but it all comes back to that delicate balance the Fed is trying to strike.
Right.
They want a healthy economy, but not one that's overheating.
Yeah.
And wage growth is one of the key indicators they're watching.
So we're watching for wage growth, not just the number of jobs created.
Exactly.
Got it. But remember how we said sector-specific risks were a big deal this election?
Yeah.
Does that play into the jobs report too?
Absolutely. The jobs report isn't just about the overall number.
Okay.
It also breaks down job gains by industry.
Right.
So if we see strong growth in, say, manufacturing jobs, but weakness in retail or hospitality, that could signal a shift in the economy, maybe even a warning sign about consumer spending.
Interesting. So even within the jobs report, there are mini stories unfolding about different parts of the economy. It's like a puzzle, figuring out how all the pieces fit together.
Exactly. And speaking of puzzles, let's talk about another piece of this market puzzle that often gets overlooked. The Treasury's quarterly refunding announcement. Basically, it's when the government tells us how much money they need to borrow. And that can have ripple effects throughout the market.
Break this down for me. Why should I care how much the government is borrowing? It's not like I'm lending the money directly.
You might not be directly lending, but think of it this way. When the government borrows money, they issue bonds. And if they issue a lot of bonds, it increases the supply of bonds in the market. Now remember, supply and demand. When supply goes up, prices tend to go down.
I'm following so far. Bond prices go down. So what?
Well, bond prices and yields move in opposite directions. So when bond prices go down, yields go up. And yields are essentially interest rates. So if the government is borrowing a ton of money, it can push interest rates higher across the board.
I see. Higher interest rates mean it costs more for everyone to borrow money.
Exactly.
Businesses, consumers, even the government itself, that's all connected.
Exactly. So even though the refunding announcement might seem like a technical detail, it can actually have a big impact on the overall market environment.
My brain is officially full.
We've
got the Fed, elections, jobs, taxes, the Treasury, and now we need to factor in what's happening globally, too.
Again, it's easy to get caught up in what's happening here in the U.S., but we're part of a global ecosystem, and what happens in other parts of the world can definitely have an impact on our markets.
So where do we even begin? What global events should we be paying attention to this week?
Well, for starters, keep an eye on the Bank of England. They're meeting this week to decide on their own interest rates. If they raise rates more aggressively than expected, it could strengthen the British pound, which could actually weaken the U.S. dollar.
Wait, so a strong British pound is bad for the U.S. dollar? Explain that one to me.
Think of it like a seesaw. When one currency goes up, the other tends to go down. And a weaker dollar can make imported goods more expensive, potentially contributing to inflation here at home. It can also impact the returns on international investments.
I'm starting to see how interconnected everything really is.
It is.
What else should we be watching on the global front?
There's also something called the Purchasing Managers Index, or PMI, that comes out from different countries around the world. It's basically a survey of manufacturing businesses, and it gives us a glimpse into the health of the global economy. If those PMI numbers are strong, it suggests that global manufacturing is humming along, which is good news for everyone.
It's like taking the temperature of the global economy, right? A strong PMI means things are heating up. While a weak PMI could signal a slowdown.
And a slowdown in global growth could have negative implications for U.S. companies that rely on exports.
So we've got global interest rates, currency fluctuations, manufacturing data. It's a lot to keep track of. Is there anything else we're missing? Don't tell me there's more.
There's always the wild card. Geopolitical risks.
Oh, right.
Think about things like trade tensions, political instability, or even unexpected military actions.
Wow.
These events can send shockwaves through the market, especially in commodities like oil.
Oh, right, those pesky geopolitical risks. You never know when something might flare up and send oil prices soaring, which of course would impact everything.
Exactly.
From gas prices to the cost of goods and services. It's like a domino effect.
It is. Geopolitical risks are inherently difficult to predict.
Yeah.
But it's important to be aware of the potential hotspots.
Right.
And how they might impact your investments.
Okay, so we've got the Fed, elections, the jobs report, the Treasury, global interest rates, manufacturing data, and geopolitical risks. That's like a whole semester's worth of economics crammed into 1 week.
It is a lot.
How is anyone supposed to make sense of all this?
Don't worry, we're going to break it all down for you.
Okay.
And help you figure out what it means for your investment strategy.
Okay.
But before we get to that,
yeah,
let's take a moment to talk about Apple's earnings call.
Ah, yes, Apple.
Yeah.
They're always a big deal.
Right.
But this time feels different.
Yeah.
It's like everyone's looking to Apple for clues about the health of the entire tech sector and maybe even the broader economy.
You're right. Apple's earnings are often seen as a bellwether for the tech industry.
Huh.
And this time, there are a few key things we'll be watching closely.
Okay.
First, their performance in China is crucial.
Right.
The Chinese market is huge for Apple. And any signs of weakness there could spell trouble.
China's like the 800-pound gorilla in the room. Right? I was wondering if the Chinese consumer is still spending or if there are cracks in the armor.
Exactly. And then there's Apple's services revenue, things like the App Store, Apple Music, and iCloud. This is a growing part of Apple's business.
Yeah.
And investors will be looking for strong growth there.
Services are the key to their future.
For sure.
Everyone's trying to figure out if Apple can keep growing that side of the business.
Yeah.
Or if they've hit a ceiling.
And finally, we'll be watching their guidance for the holiday quarter.
Okay.
This is when Apple typically makes a big chunk of their sales. And their outlook for the holiday season could give us clues about overall consumer confidence and spending.
So if Apple says they're expecting a blockbuster holiday season, that could be a good sign for the economy overall.
It could be.
But if they're sounding cautious, that could be a red flag.
Exactly. Apple's earnings call is going to be a goldmine of information.
Right.
Not just about Apple itself, but about the broader economic landscape.
Okay, so we've got a lot to digest here.
We do.
We've covered a ton of ground,
but
we're not done yet.
Not yet.
We still need to talk about what all this means for you, the investor.
Right.
How can you navigate this perfect storm of market events and come out ahead?
Yeah.
That's what we'll be discussing after a quick break. All right, so we're back and ready to tackle the big question.
Okay.
How do you actually navigate this wild market week?
Right.
It's easy to feel overwhelmed by all the moving parts.
You're absolutely right.
Yeah.
Information overload is a real risk, but remember, knowledge is power.
Okay.
The more you understand, the better you can position yourself.
So where do we even start? What's the first step in creating a game plan for this week?
First things first. Take a deep breath and review your portfolio. Look at your holdings through the lens of everything we've discussed, the Fed, elections, global trends. Ask yourself, do I have too much exposure to any one sector that might get hit hard by these events?
That's a great point.
Yeah.
It's all about managing risk, right? So if you're heavily invested in tech and worried about regulation, maybe it's time to diversify a bit.
Right.
Or if you think energy is going to be volatile, perhaps trim some positions there.
Exactly. Think about your overall risk tolerance.
Okay.
Are you comfortable riding out the potential ups and downs? Or do you need to dial back the risk a bit? This is also a good time to revisit your stop-loss orders and profit targets.
Right.
Make sure they still make sense in light of the current market environment.
So step one is taking stock of where you stand.
Yeah.
And making sure your portfolio is aligned with your goals and risk tolerance.
Right.
What's next? How do we actually stay on top of everything as it's happening?
Stay informed.
Okay.
But don't get glued to the ticker tape.
Right.
It's easy to overreact to every headline or market blip. Remember, Volatility creates noise.
Yeah.
And you don't want to make impulsive decisions based on short-term fluctuations.
So resist the urge to panic sell if the market dips.
Right.
Or chase the latest hot stock tip.
Exactly.
Got it. But how do we strike that balance between staying informed and not getting sucked into the market's emotional roller coaster?
Focus on patterns and trends rather than knee-jerk reactions. Yeah. Look for confirmation signals before making any major moves.
Okay.
For example, if the market is showing signs of a shift from growth stocks to value stocks, don't jump in right away. Wait for a few days.
Right. Or even weeks to see if that trend holds.
So patience is key.
Yeah.
Don't try to time the market perfectly.
Right.
Just try to make informed decisions based on the bigger picture.
Exactly. And remember, even the most well-informed investors can't predict the future with certainty.
Right.
Unexpected events can always happen. So it's important to stay flexible and be prepared to adjust your strategy as needed.
That makes sense.
Yeah.
So we've reviewed our portfolios.
Yeah.
We're staying informed but not overreacting.
Right.
And we're ready to adapt as needed.
Okay.
What about the aftermath?
Yeah.
How do we analyze what happened and learn from this wild week?
Once the dust settles, look for pattern confirmation. Has the market established a new trend?
Right.
Are certain sectors emerging as clear winners or losers? Don't jump to conclusions based on one day's price action.
Okay.
Give it some time to see if the initial reactions hold.
So we're looking for lasting changes, not just fleeting moments of excitement or panic. Right. And keep an eye out for what's called capitulation signals.
Okay.
This is when investors who are holding on to losing positions finally throw in the towel and sell.
Okay.
It can sometimes signal that the worst is over and a potential buying opportunity is emerging.
Interesting. So a wave of panic selling could actually create a buying opportunity.
It could.
For those who are prepared and patient.
Exactly.
It's like the market's version of a clearance sale.
Exactly. But remember, even with capitulation signals, confirmation is key.
Right.
Look for other signs of a market bottom, such as increasing volume on up days and declining volume on down days.
Okay.
It's all about piecing together the clues
and
making informed decisions based on the evidence.
It's like we're market detectives, gathering evidence and trying to solve the mystery of where the market is headed next.
I like that analogy. And remember, the market is always forward-looking, even as we're analyzing the events of this week. Investors are already looking ahead to the next set of catalysts and risks.
So it's a continuous process of learning, adapting, and trying to stay one step ahead.
Exactly. And that's what makes investing so challenging and rewarding.
Yeah.
It's an intellectual puzzle that's constantly evolving.
Well, I have to say, I feel much more prepared to tackle this week after our deep dive.
Good.
We've covered a lot of ground, from the Fed to Apple to geopolitical risks.
We did.
But hopefully you're feeling more informed and empowered to make smart decisions.
I agree. The key is to stay curious, stay informed, and stay engaged.
Don't be afraid to ask questions. Do your own research,
right,
and challenge conventional wisdom.
And most importantly, remember that volatility is a natural part of the market.
Oh, yeah.
It's not something to fear,
right,
but rather something to understand and navigate strategically.
That's right. So buckle up, stay focused, and enjoy the ride.
Exactly.
We'll see you on the other side of this market roller coaster.